Long-term debt represents funds borrowed by an organization for a period exceeding 1 year, primarily used to finance capital expenditure or expansion projects. Unlike equity, long-term debt involves a contractual obligation to pay interest and repay principal at maturity. Common types include debentures, bonds, and loan notes. The fundamental characteristic of long-term debt is the fixed return it offers lenders, which provides certainty of cash flows. Debt holders are creditors, not owners, and therefore do not participate in management decisions or residual profits. Debt can be secured or unsecured. Secured debt is backed by specific assets, while unsecured debt relies solely on the issuer's creditworthiness. Interest payments on debt are tax-deductible, which creates a tax shield advantage. However, high gearing levels increase financial risk, as entities must service debt regardless of profitability. The appropriate mix between debt and equity is a strategic decision balancing risk, cost, and control. Bonds are the most common form of long-term debt traded in capital markets. A bond is essentially a loan contract between an investor and an issuing company or government. Each bond has a par value, coupon rate, and maturity date. Some bonds are redeemable at a premium, while others are irredeemable, effectively perpetual. Convertible bonds provide flexibility, allowing conversion into equity at specified terms, which can reduce initial interest costs. The bond market facilitates liquidity and price discovery by allowing investors to buy or sell existing bonds before maturity. The pricing of bonds reflects market interest rates, credit risk, and time to maturity. From an issuer's perspective, market-based debt can be cheaper than bank borrowing due to broader investor access and competition. However, issuing bonds involves regulatory compliance, disclosure requirements, and often advisory costs. Another important category of long-term debt is the debenture, typically unsecured and dependent on the borrower's general creditworthiness. Entities issue debentures to raise funds without pledging specific assets. Convertible debentures provide investors with an option to exchange them for equity, thereby offering upside potential. Redeemable debentures must be repaid after a fixed period, while irredeemable ones continue indefinitely. The interest rate on debentures usually reflects market risk, company credit standing, and prevailing economic conditions. A higher gearing ratio increases financial leverage but also elevates the company's exposure to insolvency if profits decline. To mitigate this, companies often match debt maturity profiles with project lifespans, ensuring cash inflows from projects align with repayment schedules. Financial reporting under IFRS 9 and IAS 32 requires that long-term debt instruments be recognized initially at fair value and subsequently measured at amortized cost using the effective interest rate method. This ensures that interest expense reflects the time value of money and the real cost of borrowing. Issuance costs are deducted from the carrying amount of the liability and expensed over time as part of the finance cost. Disclosures in financial statements must include maturity dates, interest rates, and repayment obligations, giving transparency to investors and creditors. Proper classification between current and non-current liabilities is critical, as misclassification can distort solvency ratios and mislead stakeholders about liquidity and risk exposure. The key advantages of long-term debt include maintaining ownership control, benefiting from interest tax deductibility, and securing fixed-cost financing. It also allows predictable financial planning as interest payments remain constant. However, disadvantages arise from mandatory repayments, exposure to interest rate fluctuations for variable rate debt, and potential covenant restrictions imposed by lenders. Default risk remains a significant concern, particularly during economic downturns when revenues may decline. Consequently, entities must evaluate debt sustainability using gearing and interest cover ratios. A balanced approach ensures that debt enhances return on equity through leverage without endangering financial stability. Ultimately, the strategic decision to use long-term debt depends on an organization's capital structure, industry norms, and risk appetite. Highly capital-intensive sectors like utilities often rely on long-term borrowing due to stable cash flows, whereas technology firms may prefer equity to maintain flexibility. Effective debt management requires careful consideration of refinancing options, interest rate risk management, and compliance with regulatory frameworks. The finance function's role is to ensure that long-term debt supports corporate value creation while maintaining solvency and optimizing the weighted average cost of capital, WACC. Sound debt policies align with strategic objectives and investor expectations, reflecting prudent financial stewardship.